Hello guys, how are you? Today we are starting the lecture number 12 that is all about the methods of payment in international trade. That is for post-graduation program in export-import management. So what are the various methods of payment in international trade which we are going to discuss in another 40-45 minutes. So we have a numerous number of methods of payment are available in the market. So what are the characteristics, what are the advantages and what are the disadvantages of the different method of payment which we are going to be discussing? That is called least secure and the most secure if we'll talk about. Least secure, open account, cash in advance, documentary collection, letter of credit, documentary collection, cash in advance, and the open account. If we'll talk about the least secure, that is called that is all about the few documents, and if we'll talk about the most secure, so we have some other documents. So firstly, we are starting with the cash in advance. That is all about the cash against the payment, or what we can say trade against the payment, or that is actually we do in a spot market. Spot market. In a foreign exchange market, in an international market, we have forward market, we have a spot market, we have a future market. This all those markets we are going to be discussing in some other lectures. So cash in advance is all about within cash in advance terms, the exporter can avoid credit risk because payment is received before the ownership of the goods is transferred. Suppose that you are the exporter, I am the importer. Suppose that I am taking any goods from you, you will receive a product, you will receive an amount or you will receive a payment before sending the goods to the importer. Importer haven't received the goods as of now, but he has already made the payment. So cash in advance is all about whenever you are making some certain advance payment, that is called cash in advance. And the risk in a cash in advance is very less risk. Wire transfers and credit cards are the most commonly used cash in advance options available to the exporters. There are two types of modes of payment under the cash in advance, that is called whether it's a wire transfer or credit cards are the most commonly used cash in advance options available to the exporters. However, requiring payment in advance is the least attractive options for the buyer because it creates cash flow problem. Yes, automatically, whenever the exporter is asking about the cash in advance, it creates the problems for the buyers because sometimes they are having certain problems with the cash, or they are having some certain liquidity problem. So it might lead to create certain cash flow problem. That is the only reason buyers don't agree to make the payment in advance. Foreign buyers are also concerned that goods may not be sent if payment is made in advance. Yeah, sometimes it is also happened in the international markets. You have made the payment, but exporter doesn't send the goods to the importer. That is the thing. Foreign buyers also concerned about that the goods may not send if payment is made in the advance. That is the only reason they are making the payment in advance. Thus, exporters who insist on this payment method as their sole manner of doing business may lose to competitors who offer more attractive payment system. Automatically, it's quite easy to understand if suppose that you are asking about the cash in advance payment system. So you can lose certain customer also, and because your competitor also providing attractive payment terms. Suppose that you are receiving the order today as of now, and you are making the payment after 35 days, 45 days. So numerous number of the options are available for the buyers. If you are rigid with the cash in advance policies for your product and services, so you might lose from the competitors. Cash in advance method, wire transfer, that is called SWIFT, Society for Worldwide Interbank Financial Telecommunication, credit card, payment via check. Okay, CHEQE. When to use cash in advance term? The importer is a new customer, has a less established operating industry. Whenever we are targeting, or whenever we are making any agreement with a customer who has started their own businesses, they don't have any credibility in the market, then in this case, seller never take any risk. So that is the only reasons exporter always prefer the cash in advance terms. The importer credit worthiness is doubtful, unsatisfactory, or unverifiable. Sometimes credit worthiness of the importers is very doubtful, and the exporters is not sure about whether they will make the payment once they receive the goods and services, are unsatisfactory or unverifiable. You are not able to verify the importers credit worthiness. That is the only reasons we are always asking about the cash in advance terms. The political and commercial risk of the importers' home countries are very high. If suppose that you are targeting the countries like Pakistan or North Korea or Iran or Iraq, where the political risks are very much high. The political and commercial risk of the importers' home countries are very high. In such a conditions, we always prefer the cash in advance terms. The exporter's product is very unique, not available elsewhere or in a heavy demand. Whenever this is the one of the important reason. If exporter's product is very unique, if suppose that exporters having the monopoly in the market, in such a condition, in such a case, he or she is always requiring the cash in advance, because numerous number of the buyers are available in the market, but sellers is only one. So if he or if you are able to create the monopoly in the market, or you have created the cartels, so automatically you can ask for the cash in advance term. But it is not possible in all the product and services. Whenever you are doing the marketing as per the niche marketing strategy, or you are dealing with a blue ocean strategy, you must have idea about if you have gone through the marketing classes. So whether the exporters are entering the market through the blue ocean strategy or niche marketing, so exporters can ask for the cash in advance because they have very unique product in the market, and there is a very heavy demand, or there is a huge demand in the market. The exporters operate in an internet-based business where the acceptance of credit and payment is a must to remain competitive. Okay. Now, what are the characteristics of the cash in advance? Applicabilities. Recommended for the use in a high-risk trade relationship or export market, and ideal for internet-based business. Whenever we are doing any service, whenever your product is related with the internet-based businesses, it is always recommended to do your business in a cash in advance. Risk. Exporters is exposed to virtually no risk, as a burden of risk is placed nearby completely on the importer. Whenever you are receiving the cash in advance, there is a no risk as per the exporter side, totally risk at the end of the importer. Pros and cons. Pros, what are the benefit? Yeah, positive point or negative point we can say. Payments before shipment eliminates risk of non-payment. As per the exporter side, there is no risk of the non-payment because you have already received the cash in advance. Cons, may lose the customer to the competitors over payment terms. If your product is not unique, your product is very common, and there are numerous number of the competitors which is already running in the market. In such a case, what can be happen? You may lose the customer due to the competitors might provide some certain other payment terms. No additional earning through the financing operations. Okay. So first was cash in advance. I hope you had a clear understanding about the cash in advance. Next is the letters of credit or documentary credit. Letter of credit also refers to whether a documentary credit is a contractual agreement whereby the issuing bank, that is called importer bank, acting on the behalf of the customer, that is called buyer or importer, authorize the nominated bank, exporter's bank, to make the payment to the beneficiaries or exporter against the receipt of stipulated documents. Letter of credit always issued by who issued the letter of credit? Importer bank. In case of India, if suppose India is an importer, that is called Exim Bank, Export Import Bank of India. In most of the countries, they have a certain specialized bank which is dealing with Export Import Bank of the respective country. Suppose that Exim Bank is not available there, they might deal with the central bank of the countries. So who issued the letter of credit? Letter of credit always issued by the what we call Exim Bank. Yeah, in terms of India, Export Import Bank of India. So Export Import Bank of India or importer bank, they always take the guarantees on the behalf of the buyer. If something will be happen, the buyer, then Exim Bank will be responsible for same. Exim Bank will be make the payment to the exporter. So letter of credit also refers to it's a documentary credit. It's a contractual agreement whereby the issuing bank, that is called importer bank, acting on the behalf of its customer, buyers or importers, authorize the nominated banks, that is called exporter bank, to make payment to the beneficiaries or exporters against the receipt of stipulated documents. The letter of credit is a separate contract from the sales contract on which it is based. Therefore, the bank is not concerned whether each party fulfill the terms of sales contract or not. Sales it's a totally different documents. It is not it's not an agreement between the buyer and seller. It is an agreement between the importer bank and importer, and exporter bank and with the exporter. Directly, what you can say, and directly importer bank will issue the letter of credit on the behalf of the importers, and directly writing the letter to the exporters bank. If something will be happen, I will be responsible for same. So later, then sales contract is a totally different thing, and letter of credit contract is a totally different thing. Letter of credit or documentary credit. Further, we are moving towards the banking obligations to pay solely conditions upon the seller's compliances with the terms and conditions of the LC. In LC transactions, bank deals in the documents only, not solely goods. LC can be arranged easily for one-time deals, unless the condition of the LC state otherwise. It is always irrevocable, which means the documents may not be changed or cancelled unless the seller agrees. So in terms of if suppose that LC can be arranged easily for the one-time deal, you could, every time you are making the deal, you have to issue the different letter of credit. Same letter of credit, it cannot be issued for the more than one time. Okay, or unless the conditions of the letter of credit state otherwise, it is always irrevocable. Irrevocable means the documents may not be changed. You cannot make any changes. You cannot make any amendment. You cannot be cancelled unless the seller agrees. If the seller will agree, then you can cancel. You can make certain changes in the letter of credit, because letter of credit is always issued by the importer bank. So it totally irrevocable. You cannot make any changes. You cannot make any amendment. You cannot cancel the letter of credit documents. Further, moving toward the letter of credit, it is one of the most secure instrument available to the international traders. And LC is commitment by a bank on the behalf of the buyer that payment will be made to the exporters, provided that the terms and conditions stated in the letter of credit have been made, as verified through the presentation of the all required documents. So it's one of the most secure instruments available to the international market. And letter of credit commitment by the bank on the behalf of the buyer that payment will be made to the exporters. Once all the terms and conditions will be full, once all the documents will be verified, once all the documents will be presented in front of the bank, then the importers bank will be make the payment to the exporters. Okay, the buyers pays his or her bank to render the services, and letter of credit is useful when reliable credit information about a foreign buyer is difficult to obtain, but the exporters is satisfied with the credit worthiness of the buyer's foreign bank. Okay, and letter of credit also protect the buyers because no payment obligations arises until the goods have been shipped or delivered as promised. It's secured from both the side, as well as the exporters and the importers also. Once the goods will be delivered to the buyers, then only, and all the documents will be verified, all the related documents will be presented in front of the importer bank, then only it will be made the payment by the importer's bank. That is called letter of credit also protect the buyers because no payment and obligation arises until the goods have been shipped or delivered as promised. So whatever the promise you have been done so far during the sales of contract agreement. So that is the thing, once all the goods will be shipped or delivered to the buyer, then only the importers bank will be make the payment to the exporters. Now next, further we are moving towards letter of credit advising. When a letter of credit is issued, the letter of credit issuing bank send the letter of credit either to its branch office or correspondent bank, which is normally located in the seller's beneficiaries countries. Okay, it's very quite easy to understand. The branch office or correspondent bank that receive the letter of credit is known as the advising bank. Clear? All those branch office or correspondent bank that receive the letter of credit is known as a advising bank. The role of the advising banks are authenticate the letter of credit to ensure that letter of credit comes from a genuine sources. Authentication is either in the form of signature verification for a hard copy LC or by a SWIFT authentication. Okay, because it might have some certain fake letter of credit issued from some different some fraud banks. That is the only reasons the advising banks will authenticate the letter of credit to ensure that letter of credit comes from a genuine sources. And there is a authentication is either in the form of signature verification. We have to verify the signature of the importers, or for hard copies is there, or by a SWIFT authentication. So inform the seller on the arrival of the letter of credit in his favor once the letter of credit is ready for collection. Okay. Then letter of credit confirmation. When a letter of credit is issued or LC is issued, the issuing bank may request the advising bank to add its confirmation on the LC. Once the letter of credit will be issued, issuing bank what will do? They may request to the advising bank. Advising bank will be belongs to the exporter countries to add its confirmation to the LC. It's quite easy to understand. By agreeing to add the confirmation, the advising bank will become the confirming bank and undertakes to pay the beneficiary seller if all the terms and conditions of the LC are complied with. What will happen once the confirmation would be done? Though all those advising bank will become the confirming bank. Confirming bank will make the certain confirmations on the behalf of the exporter, and all the documents will be completed, all the terms and conditions will be completed. Then that particular bank will make the payment to the seller or exporters if all the compliances will be fulfilled. Okay. Such undertaking from the confirming bank is separate and in addition to the undertaking given by the issuing bank. Letter of credit confirmation is usually requested if the seller is not comfortable with the credit worthiness of the issuing bank or concerned over the buyer's country. Okay. Such undertaking from the confirming bank is separate in addition to the undertaking given by the issuing bank. So there are two different undertakings has given by the issuing bank, that is called that from the importer side, and other is from the exporter side, that is called advising bank or the confirming bank. Letter of credit confirmation is usually requested if the seller is not comfortable with the credit worthiness of the issuing bank or is concerned over the buyer's country. Sometimes we have to get at buyer's country, that is called transaction risk or the economic risk or the translation risk. So it might have happened like this. Seller is not comfortable with the credit worthiness of the issuing bank or concerned over the buyer's countries. So what can be happen? Letter of credit confirmation is usually required. Okay. In return, the seller is required to pay letter of credit confirmation fees to the confirming bank. Yes, that is the profit of the confirming bank or advising bank. That is the only reason they are playing the role of the mediator between the importers and the exporter. What they actually will do, seller is required to pay on the letter of credit confirmation fee. Okay. Who will pay? They might ask the questions like this: who will pay the letter of confirmation fees? Then seller, that is called exporter. Okay. Clear? Now next is the confirmed LC. A greater degree of protection is afforded to the exporters when a LC is issued by a foreign bank. The importer's issuing bank is confirmed by exporter's home bank, that is called advising bank. Clear? To do so, the exporters ask its customer to have the issuing bank authorize advising bank to the confirm. So advising bank will be confirmed and they can make the payment to the advising bank will become the confirmatory bank, and confirmatory bank will make the payment to the exporter. The advising bank then become the confirming bank. That is the only reason I've been told you. Then the confirmation means that the US bank adds its engagement to pay the exporters to that of the foreign banks. If an LC is not confirmed, if the letter of credit is not confirmed, the exporters is subject to the payment risk of the foreign bank and potential risk of the importing country. Okay. Exporters, then what exporters should do? Exporters should consider getting the confirmed LC if they are concerned about the credit standing of the foreign bank or when they are operating in a high risk market where political upheaval or economic collapse or devaluation or exchange control could put the payment at risk. Then what exporters can do? Exporters should consider all the getting confirmed LC if suppose that they are concerned about the credit standing of the foreign bank. It might have the numerous number of the risk can be happen with the foreign bank, that is for political upheavals, political disputes or political regions, it can be the economic collapse, inflation or the devaluation of the respective countries or exchange control could put the payment at a risk. That is the only reasons we require the confirmed LC. Next, illustrative letter of credit transaction. The importers arrange for this issuing bank to the open LC in favor of the exporter. Simple. Importers arrange for the issuing bank to the open LC in favor of the exporter. The issuing bank transmit the LC letter of credit to the nominated bank, which forward to the exporters. The exporter forward the goods and document to the freight forwarder. The freight forwarder dispatch the goods and submit document to the nominated bank. The nominated bank checks all the documents for compliances with the LC and collect payment from the issuing bank for the exporter. The importer account at the issuing bank is debited. The issuing bank release document to the importers to claim the goods from the carrier and to clear them at customs. Okay. Now, what are the characteristics of the letter of credit? Applicabilities. Recommended for use in new or less established trade relationship when the exporter is satisfied with the credit worthiness of the buyer's bank. Sometimes when the buyers is very new in the market, they are not well established in the market, and the sellers don't have any credit worthiness of the buyer, then what actually we do? But we have some certain credit worthiness of the buyer's bank. That is the only reason letter of credit always issued by the buyer's bank. Risk is evenly spread between sellers and buyers both, provided that all terms and conditions are adhered to. What are the pros and cons? Payment made after the shipment is a benefit for the buyers. Variety of payment, financing and risk mitigation options are available in the market. Complex and very labor intensive process. I've been told numerous number of the persons will be involved to issue the letter of credit, advising bank, confirmatory bank, nominated banks. Relatively expensive method in terms of transaction costs, because seller has to pay the transaction cost, buyer has to pay transaction cost. There will be an involvement of the numerous number of the costs. Okay. Any doubt with the letter of credit? Next is the documentary collection. The documentary collection is the transactions whereby the exporter entrusts the collection of the payment to the remitting bank, which send document to a collecting bank, importer's bank, along with instruction for the payment. Okay. Funds are received from the importers and remitted to the exporters through the banks involved in the collection in exchange for those documents. So funds directly be collected from the importers and directly sending to the exporters, just like a documentary collection through the banks involved in the collection. All those banks which are involved in the collection of the documents, they will make it out the exchange for those documents, and they will directly transfer to the money from importers to the exporters. Documentary collection involved using a draft that requires the importers to pay the face amount either at site, document again payment, or on specific date, document again acceptance. The draft gives instructions that specify the documents required for the transfer of titles to the goods. Although banks do act as a facilitators for their client, and documentary collection offers no verification process and limited resources in the event of non-payment, drafts are generally less expensive than the LCs. Okay. So what are the drafts? Gives instructions that specify the documents required for the transfer of title of the goods from exporter to the importer. Although banks do act as a facilitator, banks playing the role of the mediator bit for the clients. And documentary collection offers no verification process and limited resources in the event of non-payments. Drafts are generally less expensive than the letter of credit. Okay, clear? Moving towards further regarding documentary collection, are less complicated as less expensive than the letter of credit. Letter of credit is much expensive, and numerous number of formalities we have to be done with the letter of credit. There are numerous number of the banks are involved in the letter of credit, but as compared to the LC, documentary collections are less complicated and less expensive. Under a documentary transaction, DC transaction, importers is not obliged to pay for goods before shipment. It's just like a letter of credit also. Okay, importers need not to make the payment to the exporters before shipment. Once the shipment will be delivered to the importer, then only the importers will be make out the payment. Okay. The exporter retains the title of the goods. Exporter retain the title of goods until the importer either pays the face amount at site or accept the draft to the incur a legal obligations to pay at a specified later date. Okay, so the title of the goods to with the exporters, once the it will be remain with the exporters until the importer either pays the face amount at site or accept the draft to incur legal obligations to pay at a specified later date. So he or she has to be issued the certain draft on the later on date. Then only the title of the goods will be delivered, will be transferred from the exporter to the importers. Although the title to the goods can be controlled under the ocean shipment, it cannot be controlled under air on overland shipment, which allow the foreign buyers to receive the goods with or without payment. The remitting bank, exporters bank, and the collecting bank play an essential role in a documentary collection. Okay. Although the banks control the flow of document, they neither verify the documents nor take any risk. They can, however, influence the mutually satisfactory settlement of the documentary collection transactions. Okay. Now, typically simplified version documentary is a transaction flow. Okay. The exporters ship the goods to the importer and receive the documents in exchange. Okay. You will not receive the payment, you will receive only the documents in exchange. Okay. Exporter present the documents with instructions for obtaining payment to his bank. Clear? Exporter remitting bank send the document to the importer's collecting bank. Then collecting bank will verify all the document. Later on, they will make the payment. Collecting bank release the documents to the importers on receipt the payment or acceptance of the draft. Okay. Then the importer uses the documents to obtain the goods and to clear them at custom. The custom will then there will be a custom clearance. Then only they can make the payment. When the collecting bank receive payment, it forward the proceeding to the remitting bank. Then remitting bank then credit the exporter's account. It's a quite lengthy process. Okay, start from the exporter, ship the goods to the importer, receive the document in exchange. You are not receiving payment, you are receiving only document. But then exporter present the document with the instructions for obtaining payment to his bank. Then exporter remitting bank send the document to the importer's collecting bank. The collecting bank releasing the document to the importers on receipt of payment or acceptance of the draft. The importers uses the document to obtain the goods and to clear them at customs. Once the collections bank receive the payment, it would forward the proceed at the remitting bank. The remitting bank then credit to the exporter's credit account. Okay. Now, documents against payment collection. With the DP collection, the exporter ship the, that was a DC. Okay. That was a DC, but now it's a DC against payment collection. With the DP collection, the exporter ship the goods and then give the document to his bank, which will forward the document to the importer's collecting bank along with instruction to how to collect the money from the importer, because banks will be collected money from the importer, then the importer bank will arrange all the documents and will verify all the documents. Then what they will do, they will credit the money to the exporter's account. In this arrangement, the collecting bank released the document to the importers only on payment for the goods. In this arrangement, the collecting bank released the documents to the importers only on payment for the goods. Once payment is received, the collecting bank transmit the fund to the remitting bank for payment to the exporter. Okay. Once payment is received, the collecting bank from the importer will transmit the fund to the remitting bank for the payment to the exporter. Table on the next slide shows an overview of the DP collection. Time of payment after shipment but before documents are released. After shipment but before documents are released. Transfer of goods after payment ID made at site. Exporter risk, if draft is unpaid, goods may need to be disposed of or may be delivered without payment of document control. So please read down. I'm just giving the 1 minute. This is the most important slide. Okay, the time of payment after shipment, but before documents are released. Okay. But transfer of goods after payment ID met at site. Exporter's risk, if the draft is unpaid, that is called exporter risk. If draft is unpaid, goods may need to be disposed or may be delivered without payment of documents. Don't control title. Law. Documents again acceptance collection. With the DA collection, the exporters extend credit to the importers by using a time draft. It has mentioned the time when you will make the payment. There will be a certain time limit will be there, that there will be a future date. Okay, the documents are released to the importers. Documents are released to the importers to claim the goods upon his signed acceptance of the time draft. By accepting the draft, the importers become legally obligated to the pay at a specific date. Suppose that today is the 14th or 15th of June, probably. You have mentioned the date ki by the 5th of July, I will make it out the plan. I will make it out the payment. So once you are accepting the draft, the importers become the legally obligated to pay at a specific date. At a maturity, the collecting bank contact the importers for payment. At a maturity, the collecting bank contacts the importers for payment. Upon receipt of payment, the collecting bank transmits the fund to the remitting bank for payment to the exporter. Okay, the table on the next slide shows the overdue of DA collection. Clear? So again, at a maturity, the collecting bank contact the importers for payment. Upon receipt of payment, the collecting bank transmitted the fund to the remitting bank payment to the exporters. Now, time of payment. On maturity of a draft at a specified future date, I've been already told you there will be a future date. Transfer of goods before payment, but upon acceptance of the draft. Exporter has no control of the goods, may not get paid at a due date. Sometimes it can be happen on the maturity date, importers are not able to make the payment. Draft has been underpaid or draft has been cancelled by the importers. So sometimes exporters has no control of the goods and may not get paid at a due date. Now, what are the characteristics of the documentary collection? First, the applicability. Recommended for use in established trade relationship and in stable export market. Whenever the export market is well established and the importers also well settled, and it's not a new, it's a very well established and working since last 40 years, 50 years, 60 years, and there is a credit worthiness, then only you can make it the payment through the documentary collection. Risk, it's a very riskier for the export through the DC. Terms are more convenient and cheaper than the LC to the importers. Pros, bank assistance in obtaining the payment. The process is simple, fast, and less costly than the LC. Okay, because in LC both the party has to make the payment. It's very, and the LC letter of credit is very complex formalities we have. Cons, bankers' role is limited and they don't guarantee the payment. But in terms of the letter of credit, importers bank take the guarantees. Banks don't verify the accuracy of the documents, but in terms of the letter of credit, banks verify all the documents. After that, they make the payment. Okay, so this is all the characteristics of the documentary collection. Now, third is the open account. An open account transaction is a sale where the goods are shipped and delivered before payment is due, which is usually in 30 to 90 days. Okay, an open account transaction is a sale where the goods are shipped and delivered before payment is due, which is usually 30 to 90 days. Okay. Obviously, this option is the most advantageous option to the importers in terms of cash flow and the cost, because they are receiving the goods without making the payment. So obviously, this option is playing a very vital roles for the importers, because they can make it out the payment later on stage when they will deliver, once the goods will be delivered to the importers. But it's consequently the highest risk options for an exporter. Automatically, there is a highest risk options for exporter. Because of intense competition in the export market, foreign buyers often praise exporters for open account terms, since the extension of credit by the seller to the buyer is more common abroad. Because as we know, there is a stiff competition in the export market. We have to provide this type of facilities to attract the foreign buyers. Therefore, exporters who are reluctant to extend credit may lose a sale to their competitors. Suppose you are very reluctant to extend the credit facilities, so you might lose their competitors. You might lose your customer also. However, the exporters can offer the competitive open account terms while substantially mitigating the risk of non-payment by using one or more of the appropriate trade finance techniques such as export credit insurance. Yes, you might ask for the export credit risk insurance so you can secure your transactions. The goods along with all the necessary documents, are shipped directly to the importers who has agreed to pay the exporters invoice at a specified date, which is usually in 30 to 90 days. Apart from the risk, and there is a certain foreign exchange risk also, currency might depreciate it within a few days. Exporters should be absolutely confident that the importers will accept the shipment and pay at the agreed time, that the importing country is commercially and politically secure. Then only you can make it out the plane, you can make it out the plan, and you can do the trade with the open account. Open account terms may help when customers in competitive market may be used with one or more of the appropriate trade finance technique that mitigate the risk of the non-payment. Okay. How to offer open account terms trade finance technique? Open account terms may be offered in competitive market with the use of one or more of the following trade finance technique. First is the export working capital financing, government guaranteed export working capital program, export credit insurance, export factoring. Okay. Open account terms may be offered in a competitive market with the use of one or more of the following trade finance techniques. What are the trade finance techniques? Export working capital financing, which is most important, which is very common in the trends. Government guaranteed export working capital program, it's the most secured. Export credit insurance, again it's most secured, and export factoring. Then export working capital financing. What is export working capital financing? Exporters who lack sufficient fund to extend open account in the global market needs export working capital financing that covers the entire cash cycle, from purchase of raw material through the ultimate collection of the sales proceed. Okay, so suppose that you are lacking with certain cases, what you can do, you can ask for the export working capital finance, which will be helpful in the purchase of raw material until the final sale. Export working capital facilities, which are generally secured by personal guarantees, asset or receivables, can be structured to support export sales in the form of a loan or revolving line of credit. Okay. Now, second is the government guaranteed export working capital program. The US Small Business Administration and the Export Import Bank of the US, in India also Export Import Bank of India of the US, offer the program that guarantee export working capital facility granted by the participating lenders to the US exporters. In terms of the India, I've been giving the example of the US. In terms of the India also, Exim banks of the country are also providing the government guaranteed export working capital programs. With those programs, US exporters can obtain needed facilities from commercial lenders when financing is otherwise not available or when borrowing capacity needs to be increased. Third is the export credit insurance. Insurance but itself reflect that you are talking about some security. Export credit insurance provide protection against commercial losses such as default, insolvency, and bankruptcy, and certain political loss such as war, nationalization, and currency inconvertibilities. So it might have certain type of the risk can be faced, but due to the if you are opting for the export credit risk, you can mitigate this type of risk. It allows exporters to increase the sales by offering liberal open account terms to new and existing customers. Insurance also provides security for banks that are providing working capital and for financing program. Okay. Fourth is export factoring. Factoring in the international trade is the discounting of short-term receivable that is up to the 180 days, that is called 6 months. The exporters transfer title to the short-term foreign account receivable to the factoring house or a factor for cash at a discount from the face values. It allows an exporter to ship on an open account as the factor assume the financial ability of the importers to pay and handle the collection on the receivables. Factoring house usually work with the exporters of consumer goods. And further, we are moving toward the factoring is recommended for continuous short-term export sales of a consumer goods on an open account. If you're opting for the open account, then you can ask for the export factoring, but it is useful for the only short-term export. It is for maximum for the 180 days. It offers 100% protection against the foreign buyers' inability to pay with no deductible or risk sharing. Okay. It is an attractive option for small and medium-sized exporters, particularly during the periods of rapid growth, because cash flow is preserved and risk is virtually eliminated. Okay. It is unsuitable for the new to export company, as factors generally don't take on a client on a one-time deal, require access to certain volume of the exporter's yearly sales. It is for the only those exporters who are doing the businesses in last 5 year, 10 year. They are not doing the business. Only those exporters can take the benefit of the export factoring. How does the export factoring work? The exporter sign an agreement with the export factor who select an import factor through an international correspondent factor network who then investigate the foreign buyer's credit standing. Okay. Once credit is approved locally, the foreign buyers place order for goods and open account. Once your credit facilities will be approved, then only the foreign buyers place the orders for goods and open account. Then your open account will be open. You can make it out you can ask for the import from the foreign countries, and you can do the business through the open account. Okay. The exporter then ship the goods and submit the invoice. The exporter then ship the goods and submit the invoice to the export factors, who then passes it to the import factors. Okay. The import factor then handle the local collection and payment of the account receivable. During all stages of the transaction, records are kept for the exporters bookkeeping. Now, two common export factoring financing arrangement and their cost. The trade finance technique unavailable. Yeah, two common export factoring financing arrangement and their cost. Okay. In discount factoring, the factor issue an advance of fund against the exporter receivable until money is collected from the importer. The cost is variable depending on the time frame and the dollar amount in advance. In collection factoring, the factor pays the exporter less a commission charge when receivables are at a maturity, regardless of the importer's financial ability to pay. The cost is fixed and usually range between 1 to 4% depending on the country, sales volume and amount of paperwork. However, as a rule of thumb, export factor usually cost about twice as much export credit insurance. Limitations of the export financing. It exists in a countries with laws that support to the buying and selling of receivables. This is applicable in only those countries where the buying and selling of the receivables are allowed with the okay. It generally doesn't work with the foreign account receivable that have more than 180 days term. So that is only valid for only for short term or the medium term transaction. The maximum limit is that is for 180 days. It may be cost prohibited for exporters with tight profit margin. There is a very tight profit margin for the exporter. That is the only reason exporter prefer the very least. That is called export factoring. Now, characteristics of the export factoring. What are the characteristics? First is the applicabilities. Ideal for an established exporters who want to have the flexibilities to sell in open account terms to avoid incurring any credit losses or to outsource credit and collection functions. Okay. So it is applicable for the ideal for an established exporter. I have been already told you this is mainly for those exporters who have been established and who are running in the market since last 15 or 20 years and who want to have the flexibilities to sell in open account terms to avoid the incurring any credit loss to outsource credit and collection functions. Risk inherent in the exporter sale virtually eliminated. Pros: eliminated the risk of non-payment by the foreign buyers, maximize the cash flows. Cons: most costly than the export credit insurance. Yes, it's more costly, generally not available in a developing country. This facility is available in a very few countries across the globe. Okay. So again, I'm just giving the 1 minute to read out all the characteristics. Now, trade finance technique unavailable for open account terms forfeiting. Okay. The two common export finance factoring हो गया. Now, trade finance technique unavailable for open account terms, that is called forfeiting. Forfeiting is actually it is a method for trade financing that allows the exporters to sell the medium term receivable 180 days to the 7 years to the forfeiter at a discount in exchange for cash. Okay, clear? That is the maximum. Minimum limit is the 180 days. Our maximum limit is the 7 years. The forfeiter assumes that all the risk, thereby enabling the exporters to offer the extended credit terms and to incorporate the discount into the selling price. Clear? Forfeiters usually buy and export of capital goods commodity in the large project only. Forfeiting was developed in the first time in Switzerland in 1950s to fill the gap between the exporters of capital goods who wouldn't or couldn't deal on the open account and the importers who desired to defer the program payment until the capital equipment could begin to the pay for itself. Okay. Forfeited, eliminating virtually all risk to the exporters with 100% financing of the contract value. That is the only reason we are preferring the forfeiting. Okay. Exporters can offer medium-term financing in markets where the credit risk would be otherwise be too high. Forfeiting generally work with bill of exchange, promissory notes, or letter of credit. Clear? The exporters is normally required to obtain a bank guarantee for the foreign bank buyers. Financing can be arranged on a one-shot basis in any of the major currencies, usually at a fixed interest rate, but a floating rate option is also available. So financing can be arranged on a one-shot basis in any of the major currencies. Most of the major currencies forfeiting is available in the market, usually at a fixed interest rate, but a floating rate options is also available. Forfeiting can be used in a conjunction with the officially supported credit backed by the export credit agencies such as Export-Import Bank of the US or Export-Import Bank of the India. Now, how forfeiting the bar? How actually forfeiting the bars in the international market? The exporters approach a forfeiter before finalizing a transaction structure. Okay. Once the forfeiter commit to the deal and set the discount rate, exporter can incorporate the discount into the selling price. Got it? Then if suppose that you can incorporate the discount to the selling price, the importers will get the product at a cheaper rate. They might ask for the more quantity. Then the exporter then accept a commitment issued by the forfeiter, sign the contract with the importer, and obtain, if required, a guarantee available from the importer's bank that provide the document required to complete the forfeiting. Okay. Then exporter deliver the goods. Exporter deliver the goods to the importer and deliver the document to the forfeiter, who will verify the document. Forfeiter will verify all the document, pays for them has agreed in the commitment. Whatever the commitment you have done so far, you have to be provide all the document. They have to verify all the document and finally pays the payment. Since the payment is without resources, since the payment is without recourse, the exporter has no further interest in the transaction and is the forfeiter who must collect the future payment due from the importers. That is called bills of exchange sample, payable for the account of the dry Bangkok Import Bank, Accepted Import Corporation Bank, Bangkok, Rome, 15 October 1997, USD. That is called bill of exchange sample. I've been put it down. For value received against the bill of exchange, Export Limited Rome, the sum of USD dollar. This is the sample of the bill of exchange. Okay. Everybody has to sign signature of the drawer, Export Limited. Then this is a sample copy of the promissory note. Bangkok Import Bank, Bangkok. This is the same like a what we call bills of exchange. 15 August 1999, the promise to pay in a promissory note have to make the promise to pay against the promissory note in the order of the Export Limited Rome. The sum of the USD dollar, it has already mentioned in the promissory note. Effective payment to be made on the United States dollars without deductions for that, free of any taxes, imposed levies or duties present in the future of any nature. The bill of exchange is payable at the Bangkok Import Bank, Bangkok. Again, it's signed by the Import Corporation Bank, that is called signature of the maker. Who will make the promissory note? That is called bank. Now, forms of bank security, guarantee and avail. Draft will generally be guaranteed by a bank, avail or separate bank guarantees. The guarantor will usually be internationally active bank resident in the importer's country and able to ascertain the future credit worthiness firsthand. The security is important for the exporters and confirm the client ability to fulfill obligation. The guarantee enables are essentially similar with both being in their simplest form promise to pay a certain sum on a given date in the event of non-payment by the original debtor. As we know, in the case of the guarantor, the promise take the form at a separate document signed by the guarantor, setting out in a full all the conditions relating to the transaction, whereas an aval is affect duty signed directly on each promissory notes or bill of exchange. An aval makes the avalizing bank's primary obligor, wherein a guarantee doesn't. Beside an aval is transferable by nature. This is not important, even though I'm just telling you. Guarantee must state that is an unconditioned fully transferable. The simplicity and clarity together with the inherent abstractness and the transferability makes an aval the preferred from the security of forfeiting. Flow chart of a typically transaction. Exporter, credit, Swiss, juries, that's written as the mother languages, importers, importer bank. Importer will reach out to the importers bank, then importers will be take a guarantee on the behalf of the importer, will issue the open account or it will issue the letter of credit to the exporters. Okay. No, what are the commercial contract, forfeiting agreements, delivery of the goods, delivery of the draft against the shipping documents, endorsement of the draft according to the forfeiting agreement along with the shipping and trade documents, payment of total amount of draft less discount, presentation of the draft for collection of maturity, payment of draft as a maturity. Okay. That is all about the exporter, then importer, then bank, then forfeiter. Now, cost of forfeiting. The cost of forfeiting is determined by the rate of discount based on the aggregate of the LIBOR, that is called London Interbank Offered Rate, for the tender of the receivables and the margin reflecting the risk being sold. The degree of risk varies based on the importing country, the length of the loan, the currency of the transaction, and the repayment of the structure. The risk, the higher the margin and therefore the discount rate. Forfeiting can be more cost effective than the traditional trade finance tool because of many attractive benefits offered to the exporter. Okay. Now, what are the characteristics of forfeiting? Applicability. Ideal for export of capital goods. Ideal for export of capital goods, commodities and large project on medium term, that is called 180 days to 7 years. Risk inherent in export sale is virtually eliminated. Pros: eliminate the risk of non-payment by foreign buyers. Offers strong capabilities in emerging developing market. Cost is often higher than the commercial lender financing, limited to medium-term transaction exceeding $1 lakh. Thank you so much. Thank you.